Hey guys, we're here with the Holy Macro Show. We're here with Gashop today, my co-host. We have so much stuff to talk to you guys about. It's kind of funny, Gashop. I got a message from a buddy the other day that was like, "Oh man, I leave." He went on a vacation. He was like, "I leave town, and everything happens." And I was like, I basically had like training in the morning at like 5 a.m. I'm tired as hell at this point. So I actually was like dead asleep, like outside on the couch. And I was like, one, you're asking the wrong guy. I usually have no idea what's going on during the day. I'm like, two, I'm dead asleep. So what are you talking about? And he said, oh, Powell got fired. And I was like, what? And then like he was like, oh, actually, I think that was fake. And so you go online and you see there's fake news about Powell getting fired or something. And it almost seemed like they were trying to test it out to see like what people would do if it happened. So just want to pass that to you. What are you thinking about this whole situation with Powell, the Fed, the Donald Trump? I don't know if you saw the South Park episode, but man, if
Yeah.
anybody saw that, that was so. I just saw like a little piece of it, and I was like, I don't know. Me and my girl were like, we're gonna watch this last night, so we turned it on, and I was like, oh man, this is wild. So, what are you thinking about this whole situation with Powell and Trump and the idea of lowering interest rates?
So I don't think the Fed should be lowering interest rates when markets are hitting all-time highs, and it looks like, I saw the stock Open Door Technologies just go vertical like it's the GameStop era all over again, and the behavior is just getting insane. And did I posted this on Twitter the other day about how Roundhill has these ETFs. What they do is sell call options on popular stocks and harvest the yield. And right now they are touting Palantir has a 71% yield, Nvidia has a 51% yield, and they have these ETFs on all the popular stocks, and it's just getting crazy. And these ETFs now have $250 million in assets. Now, you and I remember the XIV era. You know how selling options ends. And it's just, this is not the environment in which you should cut rates. If anything, you should raise rates aggressively and make sure that some of this, Alan Greenspan coined this term, irrational exuberance. So he said this in a speech in 1996 about the dot com bubble. And then the bubble went on for another 4 years. So that's a different story. But where he said that somewhere the Fed has to take an active role in curbing irrational exuberance. Now, the Fed would say that's not its mandate, but then, hey, printing $4 trillion to fight a virus wasn't its mandate either, and they did that. So if they cut rates or take it to 1% because Trump says so, it does two things. First, it says that the Fed is under the control of the president. So you and I know, anyone who's read history knows that the Federal Reserve is a private institution which is owned by the commercial banks. I mean, they have a complicated structure and way of doing it, but that's pretty much the structure. So now when you bring it directly into government control, then every time the Fed buys treasuries, it is like the Kekule snake, the snake eating its own tail. So that's the signal that it would convey. The so-called separation of money and state would just disappear. And with that will come a complete loss of confidence. And the second thing taking interest rates low will do is kickstart animal spirits again. So, I mean, you already have the so called burrito loans, wherein you can use buy now, pay later, and pay for your Chipotle meals and stuff like that. So now imagine you take all that kind of easy credit and you put that into the stock market and have bubbles in stock like Open Door Technology. I don't even know what it does. And out of the blue, it's like gone straight up. So you have this situation. The Fed should not be cutting rates into this situation. If anything, they should be raising or holding the line or something. But then you and I, yes, we studied the Fed for such a long time, and we know they always tend to do the wrong thing. So 2019, when everything was kind of okay, the Fed did a moderate tightening. The S&P had a terrible Q4 and everyone was screaming. And Yellen came out and said, my worry is there isn't enough inflation. So then 2020, COVID comes along. They are worried there isn't enough inflation. And what's the best surefire way to cause inflation? Print a ton of money. And once they printed a ton of money and inflation went up, what did they say? They said, oh, this inflation, it's transitory. Why? Because they hadn't dealt with inflation for the last, since 2014 oil price collapse, they hadn't dealt with inflation. So all they knew was negative yielding bonds in Europe. And they just knew that inflation was permanently under 2%. And they were frustrated that prices weren't rising. They were frustrated Americans weren't paying 88% higher prices for eggs from one year to the next, which sounds crazy, but that's the Fed for you. So what did they say? They said, oh, this inflation is transitory. They may as well have said inflation is welcome because, they love inflation and what it does to the debt. And then they came out and raised rates super quick, caused a banking crisis, caused a few banks to go under, and then they did all sorts of other shenanigans with the RRPs and other stuff in order to plow liquidity. And they have always tended to do the wrong thing. And I don't know if Powell can be counted on to do the right thing. I don't even know if the Fed knows what the right thing is. But all I know is the Fed giving in to Trump at this point would send a terrible signal for the markets. Maybe it's straight on to hyperinflation and something like a Carter economy with the dollar tanking, or maybe I don't know what would come off it. I just know the outcomes won't be good.
Yeah, I think I wrote a piece called "The Fed Made a Mistake." When they started lowering rates in the first place, and I think the Fed's always like the way I look at it is always the Fed is going to be behind the curve. They're always behind the curve. When you see the market, you have inflation, it's transitory until it's completely out of control. Then they're going to raise rates really quickly. Then possibly put too much pressure on the market at a certain point. The market starts to come down. And then you have a situation where they start to be a little bit too dovish. The market starts exploding. It's just the same thing over and over again. And people like you and I, we just know that's the case. And we don't look to the Fed to save the day or anything. We're just saying, hey, this is what the Fed is doing. For me, I'm kind of looking at this, and I'll bring this one up now, which is if we're looking at the Fed and we're looking at interest rates, what we're talking about here is the Fed getting behind the curve. This is 2018. You guys have been following me for a while. You've seen this chart, but those of you who haven't, this is significant, which is you got 2018, and Kashop and I were both talking a bunch at this time. This is when the market starts to actually curl over and starts to head down. And, that was October 2018. It was, what was it? Facebook, their earnings were terrible. That was the first one. That was sometime in the summer of 2018. Then basically the rest of the FANGs at the time, not the Mag 7, the FANG stocks, FANG M, basically they had terrible earnings, and so they just started coming down one after another, crash after crash after crash, 20%, 30%, 40%, 50%. I remember Twitter, Facebook, Snapchat all just getting murdered basically. And then the Fed came in and they were raising rates at the same time. Then the long end of the curve basically said, which is the blue line that we're looking at here, basically said that was wrong. And so the Fed gets behind the curve once again. They're raising rates. The very famous line from Powell was, we're a long way from neutral. That was in the mid-December 2018. December 26, 2018, he comes out and says, we're neutral, everything's fine. The market starts skyrocketing. That's where you get that V bottom at the end of 2018 that ends up in a rally for all of 2019, basically. Then you get to the point where we're at today. I won't even talk about COVID. Obviously, taking rates to zero is always going to be an issue. But COVID happens, and then we get all the way to where we're at in 2024. Same thing. They start to lower rates. The 30-year says, okay, well, we're going to just go the other direction with that. And literally the same exact day that they started to lower rates, the 30-year bottomed and started to go higher. That's the reason why I always say, you got to watch the actual yields instead of what the Fed's doing, because it's always going to tell you a little bit more of where yields are possibly heading, more than what the Fed is just telling you. And not to mention, these are two different parts of the curve. When we look at this brown line here, this is the effective federal funds rate. So the Fed rate is always going to affect the short end of the curve, especially the 3-month bonds. That's basically what they're tied to more than anything else. This creates a lot of liquidity and so on, which is why they're tied to the 3-month bond. However, the 30-year, 10-year, the long end of the curve, they do not control that. unless there's a certain operation that they haven't done in a long time. We'll see if that happens again. But I think this is about to get out of control. I think this is about to head a lot higher. What do you think about interest rates? Are you going higher, lower? We haven't really talked about that. You usually have interesting thoughts on that.
So everything depends on what the Fed does. And I know it sounds like I'm hedging or something, but the fact is, since COVID, the Fed has mattered more than ever. Every time a governor comes out and says something, markets react a certain way. And every time they actually do something, the markets react a certain way. And that's just because of how financialized the economy is. And that's just also because everyone is watching the Fed. Now, when everyone is watching the Fed, everyone is reacting to the Fed. So you have that situation. And then fundamentally, as you pointed out, the moment the Fed started to cut rates, the bond market said no, and they started to raise rates. And that's because the inflation problem isn't solved. In fact, it's only getting worse with the tariffs, which we just saw with the July CPI print. So it's just getting worse. So what's going to happen is the Fed will either have to say, we are going to target the long end, do something like Operation Twist, which they did before. So there was QE, everyone knows QE, which was their term for money printing after the GFC. And then they had a QE2, and then they had an Operation Twist where they said, we are going to sell our portfolio of short term bonds and buy long term bonds. And this is to keep long term interest rates down. So now the Fed can do something similar and just start buying the 30-year treasury. So what this will do is, if the 30-year is controlled, then effectively you get a Japan-like situation. In Japan, the Bank of Japan is the only bid on all these bonds because no one else wants to take the risk. So the Fed will end up controlling it. And other than mortgages, no one really takes such long-term debt. So even corporate bonds, most of them are 10 years, maybe 15 years, and that's about it. So you will see pressure on that part of the curve. So if Operation Twist or the Fed starts buying those bonds, then there's no telling what will happen other than the fact that the dollar will tank. That is, I think, almost certain to occur. And that's just based on what's happened before. So when we saw the Japanese central bank do this kind of operation in the market, they started buying stock ETFs, they started buying all the bonds, and the yen just tanked. The From 2014 all the way to 2024, the yen just tanked. So I think it went from a high of 80 to the dollar to something like 145, 150 to the dollar. So crazy levels. So just steady depreciation of the currency. Now, the US, because it's a reserve currency, is going to take a longer time to depreciate that rapidly. But then you never know, because what we saw in the 1970s was you had these two good years from 1974 to 76, and then the economy started tanking again, inflation skyrocketed, and it got to a point where uh, foreigners did not want to buy US government debt. And this was under President Jimmy Carter, and he had to issue debt in Deutschmarks, which is the precursor to the euro, which is the German currency, and he had to issue debt in Swiss francs. So international bond vigilantes were saying, no, we don't want dollars. Now, can a situation escalate that rapidly in current times? You never know, but we know it's happened before, and we shouldn't be surprised if it happens again. So that's my answer. I don't know what the Fed will do. I don't know what the bond market will do, but we should be prepared for any possibility, from Operation Twist controlling the bond market to a full blown Carter economy.
No, I think so too, and I have to dig this up, but I have a back test where I go through basically the quantitative easing periods and Operation Twist, looking at stocks, commodities, currencies, and so on. I'll try to see if I can dig that up at some point. I'm sure you guys would like to see that. I would like to see it again, just because it'd be an interesting time for them to try to do something like an Operation Twist. But my big thought here is let's look at this applicable to trading. So if we apply this to trading, what exactly is going to happen? And then we say, okay, well, the Fed, there's two scenarios. Powell stays steadfast, which is the number one scenario. He goes, hey, I'm not moving rates. I'm not moving them up. I'm not moving them down. We're just going to stay here. He keeps arguing with the president and so on. And then there's the other one, which is maybe there's a possibility of somebody else coming in, lowering interest rates. Let's just say hypothetically, he does get fired. I think that's impossible, but let's say anything can happen, especially nowadays. I'm not going to write anything off. So let's say he gets fired. Let's say this is just for just to think about. Let's say rates go down to 2%. Somebody says, hey, you know what? We're going to lower rates very aggressively, 50 basis points each time till we get to 2%. What do we think would happen to commodities, stocks, and gold and so on in that scenario?
It will melt straight up. So November 2023 is the reference. So when I think it was end of September or end of October that FOMC, when the Fed came out and said we are going to pivot, everything went straight up. Like for an entire month, everything went straight up without stopping. So if the Fed does do something like that, then that's what's going to happen. Now, the real question is what happens to the dollar at that point? Are people still going to make long-term contracts in it? What happens to the swaps market? I'm pretty sure if the dollar moves big, someone's going to blow up, because what we saw with the CHF EUR crisis when they lost the peg, that's just going to be something similar is going to happen in the swaps market. Now, as for Powell, so here's the thing. So Powell is an ex-private equity guy, and I don't know how reliable the estimates are, but he's supposedly worth something like $400 million. Now, he doesn't have to really get fired. If he just says, you know what, I'm an old man, I'm rich, F you, I'm off, I don't need this crap this late in life, and he just goes, what happens then? The
Yep.
next guy who comes in, he's going to be a lot more deferential to the president's wishes, because he knows what happened to his predecessor. And whoever is in the board of governors who is only there out of loyalty to Powell or because they see this as a fight worth fighting, they leave and you populate the entire board with just doves. What happens to rates then? So these are all possibilities, but all these possibilities, all these scenarios, however you slice them, they all just point to one fact: this is all bearish for US dollars. And that's the only obvious trade that I can think of in this, which is you have to make bets which are bearish the US dollar. Now, had you done this kind of trade at any other point in time, you would have lost money, which is what makes it scary for people to think we are betting against the dollar. Does that mean that you're betting against America? Does that mean you're betting against the reserve currency? Now, gold bugs, the Bitcoin guys, the crypto group, everyone, the Austrians, of course, we all know what this means, but for a mainstream investor, it's something new, especially when we have seen this phenomena where earlier used to have ETFs for all these exotic countries. You wanted to invest in Vietnam, Vietnam is still there, Turkey, Tanzania, some far out African nation, Tajikistan, Azerbaijan, you name it, you had products that let you invest in all those markets. And then they lost popularity and people stopped investing in it, and the ETF shut down. And recently, the offshore oil drillers ETF shut down. So that gives you a sense of sentiment in the markets. Now, in this scenario, if the dollar tanks, what is the obvious trade? The obvious trade is to buy international stock ETFs. And I think those will come back in popularity. And that's something that you can monitor for opportunities.
I think we're in that scenario. I think the market's just screaming that that's the scenario, and that's the thing why I'm such a price action guy. It's not because I don't think fundamentals matter. It's the fact that it usually just front runs the fundamentals. I mean, look at the dollar starts to come down a little bit, but international stocks were already starting to move. The move started last year, and a lot of people don't know what China was up 30 or 40% last year, somewhere between that. So, I mean, China was already moving in a big way. And then coming into this year, now we're seeing the continued move. And I think it's people keep looking at like this chart, for example, and they'd go, okay, yields moving up means dollar moving up. And like I've disproven this so many times, but at the same time, people continue to write me about this all the time. And I'm like, correlations change over time. If you look at the dollar, it's very cyclical. And it all really has to do with what the Fed's doing, money printing, what's exactly going on with the market, where are people investing, and so on. And then yields, like they're in this 40-year cycle that's been kind of going on since the 1800s. And it's not perfect. Once again, like, you're between 30 and 40 years most of the time. The last one, 82, 2020, 38 years. The first one was nearly perfectly 40 years. So, you look at these things and you can't say like, okay, it's a perfect way to look at this. But if you look at the dollar, you see all these peaks. You see 3 peaks basically from 71 on. And that doesn't coincide perfectly with yields. And not to mention, if you just throw a correlation thing on there and you go further back than the last 5 years, which is what everybody does, it drives me crazy that traders do this. It's like there's a lot more market history than the last 5 years, last 2 years, or they'll send me a correlation chart of what's happened this year. Once again, it's like correlations shift and they change over time. It's the reason why intermarket analysis is great. But at the same time, you have to understand those things change all the time. The relationships change constantly. And so if you're looking for that to be your go-to, where you look at the 30-year yield and you look at the dollar and you go, okay, they were correlated pretty heavily since 2020. So now I'm going to think this is going to continue to happen. That's a really bad way to look at these things. The way to look at it is correlations change and shift over time. I don't know where yields are. Like everybody keeps pointing to this one. This one's the one that drives me the craziest, which is oil and the dollar. They go, look at the dollar and oil. It's moving together. It's always going to move together. Get the F out of here. I'm going to try not to swear on YouTube today. But man, like that is bullshit. I did it already. Okay. But anyways, it's just total BS. That is not how the market moves. Like it's not you look at the dollar and oil moving together and you think that's going to happen forever. And people make these huge theories. Oh, we're the biggest producer of oil now and we're doing this. And that means the dollar and oil have to move together forever. It's like, no, that's going to shift. It's going to change. Things can move together for a time. Kashop and I both remember a time very recently, which people forget in market history, where the dollar and gold were moving up together, and gold miners actually in 2019. The dollar was strong in 2019. I remember being long dollars, gold miners, silver, and it was just crazy to think like that's what I was long. Not to mention some of the international stocks did really well that year. Brazil did really well. I think they were up 30%. Russia was up a little bit over that, and Greece was up the most that year. I think it was up 60% or something crazy. Very similar to this year. So, you see these kind of moves that happen, and you got to really understand like markets are always shifting, dynamics are always shifting, the fundamentals underneath it are always shifting. So you're not going to know that this is going to happen in this perfect way. And really for me, like looking at the dollar, like I could see bounces happening. I could see the dollar getting back up to, 100 something possibly, but I don't even think that. I really just think it's going to make a lower high and just keep moving lower. I can't see any reason, especially fundamentally. Positioning wise, I could make a case that the dollar is a little bit oversold here. I even hate that term, but it could bounce. It's kind of like when you look at positioning the way it is for the dollar right now, kind of think of a beach ball and trying to hold that underwater. The positioning is at some point is going to make a bounce. However, like once it's out of the water, it's going to you can push it right back down again. And that's what I think the dollar is going to probably continue to do. I think the dollar is most likely headed to 90. So what that means is what Kashop's saying really matters, because we need to start really getting involved with the weak dollar trades that people haven't been doing for the last 15 years. Like people haven't been thinking, I got to look at a weak dollar trade. What's the weak dollar trade? Because you've learned, and most traders have learned, that markets move a certain way. You're going to buy technology. You don't bet against the dollar. Hell, let's be honest, most American investors do not even trade currencies at all. So you just continue to trade technology. You continue to get long the same things over and over again. But when that shift happens, and it's happened many times in history, we could talk about the 30s, we could talk about the 70s, we could talk about the 2000s. you're going to see that weak dollar trade come into play, and most people are still not going to know what to do. And it's already happening. It's been here since 2020, basically, in different times. Yes, we had that massive peak in the dollar in 2022 from that run that started at the end of 21 into 22. I think it ended in October 22. But that was a very specific move. It crashed the whole market and everything. And now we went back down. The dollar's moving down once again. So it's time to make money in these weak dollar trades. And nobody's thinking like this right now, which is great. To me, it's awesome because it's a way for you and I to make a lot of money while people like I remember you getting on the show earlier this year and us talking and you going, yeah, it's been a pretty easy year. And like, I had to think about it for a second and think about like the conversations I have with my friends and my buddies. And I'm like, yeah, for me and you, we've had a pretty easy year understanding the macro. But then the people who were like, hey, I got to buy technology, I got to do this, I got to do that, they got murdered at the beginning of this year. And so, like, you and I were putting in good returns in Q1, Q2. And then these people basically now they're all like, everything's great, everything's awesome. And it's only because they're just invested in the United States. Where are the major returns, though? That's a thing that like people don't understand about trading. That is one of the most important things that you have to think about all the time, which is, are you trying to perform like the S&P 500 or are you trying to outperform the S&P 500? If you're trying to outperform, you got to understand where either relative strength is or what the macro is doing. And if the macro is doing, hey, we're in a weak dollar trade, gold miners are up 60%, and the S&P 500 was basically flat at that point. So that's telling you something. Okay, well, the weak dollar trade's here. Copper starts hitting new highs. And you're like, hey, the S&P 500, I can buy any of these stocks and I'm doing well. Yeah, sure, you can perform like the S&P 500, or you can outperform and go to something else like copper miners, which look insane. I want to ask you some questions about that later. But, you got to really understand, like, there's different regimes in the market, higher yield regimes, lower dollar regimes, what's going on with international stocks, what you want to do with the commodities, like different asset classes. This gives you some way of trading well all the time that will make you money most of the time. And so that's important. I mean, even in 2022, remember, we could be short, basically all of these currencies, being long dollars, and you could have made money that year in short bonds. So once again, it's an interesting thing because people go, okay, bonds got to go like this, the market has to go like this. It's like, wait, no, 22, we were also short bonds while being long dollars. And like then you get to here today and you're like, well, I'm actually still short bonds and now I'm short dollars. Like, things just shift over time. So don't be afraid to take those trades. Don't be afraid. Somebody asked me the other day this question, and I'll move on, which is, if you have if you're in an environment where it's a risk off environment and then you get signals to go long commodities, what do you do? I said, I go long commodities. Like, the signals are there for me, and that's where I always kind of go to, as long as the regime makes sense. And so I think that's what's important here is like continue to be open-minded to some of these things. Like if you're not going to be open-minded to some of these things and some of these trades, you're going to get ran over in the next couple years. But if you're open-minded to, hey, commodities can start moving, I want to be in some of these different things. I see Wavy mentioned Newmont. Like, we're seeing all of these trades really happen, and people are still kind of writing it off like, hey, this isn't happening right now. Let's buy technology. It's like, well, you could have, if you're a good stock picker and you feel that way about technology stocks, you could have picked some of these gold miners or, what's SBSW. I just saw year to date, it's up like 200%. I mean, like you could buy some of these gold miners and make a lot more money, or you could continue to buy the Mag 7 or what everybody else is buying, and you could just perform flat. And that's not the goal as a trader.
So in the 70s, Doug Casey, who was one of the original newsletter writers, he mentioned that by 1978, the dividends he was getting from his South African mining stocks was more than his cost basis on those companies, which is insane. But if you think about it, it makes sense because what happened? The gold price went up, and these companies, instead of blowing their money in one acquisition after the other, they return the money as dividends. And that was the era where everyone wanted dividends. This was not the capital gains, the shared buyback era. This was the dividends era. Now, if you look at mining stocks, a lot of these companies pay monthly dividends. And that's just because of the institutional mandate. So the kind of people who own mining stocks are very, very different in terms of how they are wired, how they are managing their portfolio as compared to the tech guys. The tech guys just want growth forever, and you're not going to get growth forever. In the mining world, you get dividends forever. I mean, assuming the price goes up, which is what it is currently doing. So it requires a shift in mindset. Now, when you get those dividends, what do you do with it? Maybe you want to put that into some growth opportunities. So it's a different way to manage your portfolio altogether when you buy into the mining stocks.
Yeah, and speaking of, different ideas, markets changing, so many people don't think about this. And I posted this the other day. It was a chart from Goldman, and I just thought it beautifully showed, how the market shifts over time. If you think about the early 1900s, we're looking at farming and agriculture, real estate, financials being basically everything, the entire market at that point. Then transports end up taking over. Then you start getting into different technology, and then you start getting back into energy once again. I mean, it shifts over time. So I think too many people get stuck in this idea where markets have to be the same. Like where, you got to think about if you had let's say a great great uncle. I have a great uncle who's an investor, and luckily he was very cyclical in trading. He loved the idea of changing into different markets and different themes and so on, because he saw a lot of that. But other people might be like, hey, I have this General Motors stock. You got to just hold that for the rest of their life. They tell their kid, then their grandkid, and so on. They're holding General Motors stock forever. But then you're missing out on the next trade. You're missing out where the market actually is heading to. You're missing out on the next thing that's going to make a lot of money. And I think that's a really important thing to think about, which is market shift. They change over time. Like, I'm not wed to being in gold miners forever. Yes, it'll work now. It'll work in this environment. I think it's great for this environment. However, I know there's going to be a time where I'm going to probably be back into technology. I know there's probably going to be a time where I'm heavily into energy or transports or whatever. It doesn't matter to me. And I think that's the thing that traders really have to get in their head is like, why do you care so much about, like, when we talk about international stocks, you and I talk about this all the time. People will write me and be like, well, I just can't do it. Or how do you invest in China? And I'm like, it's an ETF, man. Like, you're in the United States. There's an ETF. There's a million different stock tickers that anybody can trade. What are you talking about anymore? But a lot of people still feel like they can't do it. And even if they know all those things, they're just like, hey, I can't do it. It's un-American. Or they just, and not to mention, I was talking to somebody the other day, and they like kind of got snooty with me about it. And I was mentioning, because they were saying, we have a home country bias in the United States. And I said, actually, globally, people have a United States country bias. And he said, no, it's a United States thing. I said, no, if you talk to people around the world, they think that they also need to just invest in the United States and in the S&P 500 and in these big technology companies, because their returns will not matter if they do anything else. And that's something that's very different lately, but it also tells you that at some point that's going to shift. And we have seen that shift happening already. And no matter what people want to say, like, I could point to the 1 month rate of change in international stocks and how quickly that's been moving up. I could point to the fact that emerging markets have better growth and GDP projections than anywhere in the world right now. I can point to a million things to tell you why emerging markets will probably continue to move higher over the next year, but people will still probably point to the fact, well, the United States has outperformed very well for so long. But when you look at this chart or this diagram, you kind of see that things go through cycles. And like, granted, I'd love to make another one of these, and maybe I'll make one of these at some point myself, but of international stocks. there's been many times where international stocks have massively outperformed. I've pointed this a couple times. If we look at something like 2000 all the way to 2008, international stocks murdered the United States. And a lot of people will write me back and be like, well, Jason, the United States didn't do that bad during that time. And I will point to the fact that, yes, the United States was up 70% from 03. If you cut straight from the bottom in 03 after the recession, all the way to the top in 07. Yes, the United States hit 74% or something like that. But if you look at China, they were up 300. You look at Brazil, it was up 700. You look at just Latin America generally was up 600. I mean, so where do you want to be positioned? Not to mention commodities. Some of these went crazy. Some of the gold miners were up 3,000%. The copper miners, some of those went up 5,000, 6,000%. I mean, so where do you want to be positioned is the question I continue to ask people, and I think I've said it 5 times on the show already, but like, where do you want to be positioned? Do you want to outperform, or do you want to just do the same thing over and over again?
Yeah, and also the S&P. So had you held it for the entire decade, the 2000 to 2010 decade, you actually lost money. So all these guys saying that stocks for the long run, you just have to buy an index fund, add every year, and you'll end up rich. It doesn't really work that way. You have these periods where you have 10 to 12 years of absolutely flat returns. Do you really think, given current turnover of stocks, like nobody holds stocks for more than 2 3 months at a time now? It's gotten that ridiculous with all these meme stocks and trading frenzy. Do you really think anyone will stick to a strategy even though it mathematically is proven to work? Do you think they'll stick through it if there's a 10 12 year period of zero returns? So before you answer that, so I just read this fact. Peter Lynch, he has one of the best track records in the mutual fund industry. So he ran the Fidelity Magellan Fund, posted tremendous returns trading international stocks. And a study by Fidelity found that the average investor in the Magellan Fund lost money throughout this period, which is insane. The best performing mutual fund in all of history, and the average investor lost money. And that's just because of the timing and because of the volatility. So when people say S&P 500, S&P 500, just stick to it through the drawdowns and everything, I really don't think that's going to work. What are your thoughts on that?
Yeah, I think, once again, when we look at things like buy and hold people, or people who just say, hey, you just buy these companies and you really like Peter Lynch, for example, and I think a lot of people think of me as like a person who'd I've read all of these. And like Peter Lynch, for example, like was one of the first people I was like, oh, it's probably kind of interesting. Wanted to read more, learn more about him, and just, hey, just invest in what you know. Like, hey, you like this one brand around you, like make sure you know it well, invest in it, and so on. Maybe for the normal person that might make sense, like if you're a normal person, sure, but at the same time, like that same company that you might enjoy that's sitting around you could go to zero. A lot of people don't think about a lot of stocks can go to zero and do go to zero at times. So you have to be very agile as a trader. Like GM, like you really want to still be in GM? Like probably not. Like do you want to really trade GE? Like GE's picking back up once again, but I mean it went to crap for many years. ExxonMobil, even, like, did you want to be an ExxonMobil from 2014 to 2020? Absolutely not. So I'm not just hating on technology stocks. I'm not hating on any stocks. I'm saying that you have to be very open-minded to shifting the way you trade at times. Not being afraid to buy technology when you don't want to, if you have the right regime, the right signals. Not being afraid to buy oil stocks when you have the right regime and the right signals. Like, however you do it, just do it in a way that at least gives you the ability to move from one thing to another. Kashop and I have seen so many of these cycles kind of run through with and not to mention like our studying of it. Like studying of it is so important. I think more traders need to really dig in and understand that, because that way you would not continue to just stay in a fund because somebody says, hey, I do well over a 50-year period of time. Yeah, also the S&P 500 does too. But what if you need that money? There's going to be people, there had to be people retiring in, 2008. There had to be people retiring in 2009. You had like 50% of your wealth basically wiped out, and then you got to like take some money out of it. It feels pretty bad. So how do you, because that's really the secret of good trading, good investing, good long-term wealth generally, is keep your drawdown small. So how do you do that? Well, you have to be flexible. My great uncle would always talk about things where we'd go from, conversations about, oh yeah, technology stocks, internet is great, blah, blah, blah. And I really had no idea what he meant by that, and then you see the dot-com boom, and then he goes, oh my gosh, this is insane. I'm going to start buying microcap stocks and so on. And then he's making money there, and he's buying commodities, and he's buying international. And then you get further down the road and you go back to technology once again. It's fine to, that's how you got to trade. That's how you do this well. But then there's the people who just go, hey, if you just keep investing in these companies, sure, if you want to buy the Mag 7 and you want to hold them for 20 years, you will probably be okay. No, I'm not going to do it, but you will probably be okay. But if you're a person who's like, hey, I'm trying to perform well every single year, I know people who are psychos, they want to perform well every day or every month. It's impossible. But let's say you want to perform well every year, like I do. I want to be in the strongest stocks all the time. I want to be in the strongest sectors all the time. I want to be in the strongest asset classes all the time. And I don't care if that's Apple. I don't care if it's copper. I don't care if it's bonds. I don't care if it's currencies. Like, it doesn't matter to me. So I think that's just got to be it's the main theme of what we're talking about today, whether it's Peter Lynch, Warren Buffett, all of these people. You want to be like Warren Buffett, great, but it's not the style of trading that I think will work well in the coming century. I think the style of trading that's going to work well is more of a macro style where you're, like Wavy just said, cyclical. Perfect. Well said. It's cyclical. You go from one cycle to another. You understand what the market's kind of giving you, and you just take what the market's giving you. And that way you're going to make a lot more money than trying to be wed to an opinion. But let's go a little bit further back with this, because this one goes even further back. I'll get to your questions soon, guys. We actually have a little bit more time today because I don't have a video at 11 today. So going to this one, we're going further back. We're going all the way to 1800s. So what? When people look at this and you see like how much the market was, like that was the thing that was kind of, of course I don't really study the 1800s as much as I probably should. Civil War, different times during that, the United States, like, yes, I know a lot about that stuff, but the market history, the weightings of the market, the stocks in the market, I didn't know that much about. But seeing like we were 100% in finance and real estate, which means farmland, agriculture, and so on, like that's pretty interesting. And then moving forward, getting into transports, and we're at its peak around 70%. And then energy, materials, like we're at its peak around 40%. And now we're back to that peak in 2000 with technology. So this is just another chart to show you guys how many shifts there are in the market, and thinking, hey, technology's been kind of there for a long time. Do we think that that's just going to continue to happen forever? I don't think so. Do I think like Apple's going to disappear? No. Do I think like you're fine to trade it? Great. You want to trade it? Fine. What I'm saying is, if you want to outperform, start looking at other sectors, at other things that are a lot smaller in the S&P 500. Something you and I have talked about a ton, which is when we look at something like energy and we see like this is the smallest sector in the S&P 500 and something everybody uses every day. If you're living at home, you're using energy. If you're going to the store, you're using energy. If you're filling up your car, you're using energy. Not to mention, let's even bypass how many things, plastic and and other things that contain oil, lead, and other products. Like there's tons of them. So if we look at that, the understanding that, hey, at some point I feel like we could possibly be back into this energy materials thing. At the very least, do I think it'll be the biggest sector in the S&P 500? Probably not. Do I think it could start to take up, at least 20% of the S&P 500? Yeah, I do, for sure. So what do you think about that idea that we're possibly moving more into an energy, materials, gold miners style environment that we just haven't seen in a long time?
So that's that question is tied to what is my view on inflation, right? So I think inflation is going up, and when inflation goes up, you see commodities perform, you see commodity related sectors perform, and because you see that shift happen, you'll see a valuation reset for other sectors. Now, it doesn't mean that Apple has to disappear or Microsoft has to disappear. It just means that so the market is a function of both companies growing their sales and earnings and the multiple that investors are willing to pay for those sales and earnings. So the companies, Microsoft, Apple, etc., they have demonstrated the fact that they are sticky, they have a moat, they are capable of growing their sales and growing their earnings. But what investors are willing to pay for that, that's not an established fact. That just depends on people's mindset. So today a company might be worth 10 times their revenue. Tomorrow it might be worth only 2 times their revenue. So it's like Warren Buffett says, Mr. Market is a moody animal. Sometimes he sells too low, sometimes he buys too low, and that's going to happen. Now, energy earnings right now, nobody cares. Absolutely no one cares. In fact, the contrarian signal was the offshore, the only remaining offshore oil services ETF just shut down. And you remember in 2020, just before the shipping stocks took off, we saw the same thing happen with the shipping ETF that got shut down. And then the boat ETF came on, I think, a couple of years later. So there was this gap where shipping stocks did well, but you had to pick the stocks because there was no ETF. Now we are seeing something similar happening in the energy space. I mean, XLE, that's going to be around forever. But if you look at the subsectors within energy, you look at the subsectors within materials. So, for instance, everyone's talking about rare earths. But if you actually look at the rare earth and strategic metal ETF, that's all lithium, that's all China. There isn't allocation to actual rare earths miners, and that's just because it's tiny. It's so tiny it doesn't fit into an ETF. So what has to happen for these products to come up? The sector has to get bigger, and that will happen because capital floods into the sector. So it's all a function of liquidity. So it's not that you will see these tech companies decline in sales or decline in earnings, but the premium that market gives those sales and earnings, that's going to decline, and with that the weight in the index. And I mean, I've always come out and said Nvidia, that's a bubble that's going to burst, and there's like a lot more to it if you see my page. But the other stocks, what's going to happen is you're going to see compression in terms of the earnings multiple, in terms of the sales multiple. And with energy, you're going to see an expansion in terms of the earnings multiple and the sales multiple. Now, the beautiful thing is if an energy stock is trading at 10 times earnings and earnings increase 20%, and then you see the earnings multiple on the stock is given increase, then you're going to see something like 30-40% share price appreciation. And then you can just keep going, which is where you have these multi-baggers. And then you have these situations where, for instance, with energy especially, so I'm going back a little, but the energy sector in the US really took off, as in US oil companies really took off because the IRS changed the tax code sometime around the 1940s, and they said whatever money you spend exploring abroad, you can deduct it from your tax bill here. And with that, US energy companies went, scored the world for oil, and they dominate that space. Now they still continue to dominate that space. So once capital comes to these sectors, you're going to see news of a hot well in Namibia or a hot well in Suriname. That's going to become news. The news is not going to be Jensen Huang going to China. The news is not going to be what's happening with Intel. You're going to be seeing all these wild discoveries hitting the news. that's going to ignite people's speculative fever. And we have lived through these cycles. We have seen this in 2016, where you go find gold in a remote part of the Andes Mountains. Everyone's like, hey, wow, and we are going to drive the stock up 100% in a day. So you're going to see those kind of moves happen, and that's really where the money will be made.
I'm on mute. So no, that's great. And let's hop into. We got a bunch of charts. Just want to highlight a couple of them. I'll run through these pretty fast. This one's significant to me for many reasons, but the one reason is I love Bollinger Band squeezes. It's a monthly chart. This thing has come up on my scan every single day for, let's say, the last 3-4 months. And just seeing where it's at today is just kind of saying, okay, this is about to break out. And what I want to explain here is if you see something that's coiling, and here's what we're looking at coiling. Now, granted, it's not as tight as you'd see like on a daily chart or a weekly chart. Long term, though, this is very low volatility for a monthly chart. You do not see these much. And when these happen, you see either big breakdowns or breakouts. Now, once again, volatility doesn't tell you the direction of the move. So basically, what we're looking at with a Bollinger Band squeeze, that means low volatility. It's not going to tell you the direction, but it's telling you a big move is coming. But if I see this thing moving in an uptrend and it's coming from a massive uptrend and then consolidating sideways, ready to move higher, I'm going to bet on more upside here. So I do think this thing's going to break out pretty soon. And I think that's going to be the thing that brings oil back into the picture. I think a lot of people have just written off oil as, hey, it's dead. I had somebody have a conversation with me the other day and they were like, just things have changed, solar, all this stuff. And I'm like, that's not it. It's same with coal. Like we still use a lot of coal. Please go look it up. I think it's still the most used energy source for housing in the world. So that, and not to mention in Asia, in the United States, we still use it, even though people think we don't use it here. We absolutely do. They're even opening up certain coal reserves. Like a part of my own thought theory of why we're doing so many things with the parks. It's an interesting piece of history. I'll go through it real fast. Nixon was the one to say, hey, we need all these public parks. And so we started to put all this land and basically go, okay, well, you can't go into this land. We need this for public parks. And I like parks too. I love being outside. However, let's think about Nixon's real motives. Why, when you go to a park, I mean, there's a place called the Wilds in Columbus. When you go there, it's built on an old coal mine. Like if you go to another park, you'll see it's mainly built on some sort of reserve. Could be oil, could be coal, could be something. They do this over and over again, and it's for a reason. It's because at some point we probably think we're going to need these things, and so we've made it so nobody can touch it for now. Nobody can buy it, and so at some point the United States is going to feel like they need these things. So, anyways, my point is that energy is very useful. We still think we really need these things, and we might be rolling back some of the rules in the United States so we can use more of them. Palladium and platinum. This is my, I hate the word catch-up trade. It drives me crazy. However, this is kind of a catch-up trade. Platinum was the one that exploded higher. Coming out of this massive band squeeze, if you look at a monthly chart of platinum, it was like the most textbook band squeeze ever. Sam actually mentioned that he he wrote the CMT to say like, hey, this better be in the next book because it's the best band squeeze you're ever going to see in your life. And it's true. Like this is a massive band squeeze. What's platinum up right now? 60% this year. I mean, that's wild because it just started. That just happened in June, I think, or May. So this breakout, I know the breakout happened in June, but I think it bottomed in May. And then it's moved a lot higher. Now we have palladium right behind it. Palladium's moved up, I think, almost over 30% this year already. It will probably still continue higher. So I do think we have a couple great setups in the metals and mining space that are outside of gold right now. And so I want to keep an open mind to what's moving outside of gold. And then the silver to gold ratio. I highlighted this chart a bunch, but I think what I just want to say here real quickly is the fact that if you think that silver is done, you're crazy. Like if you think that the regime has changed and that silver will never move again, you're crazy. Like the way this works and the way every asset class works is you go to the safest things first. When markets bottom, what are people buying? Are they buying like, the greatest meme stocks of all times in 2009 or at the bottom in 2020? No, they're buying the biggest names. The biggest, safest names is what they're going to want to be in. It's the same for gold and the precious metal space. People wanted gold first. Not to mention the central banks started buying gold very heavily this time, so that really made this outperform. So gold was the massive outperformer. Now we're starting to see silver catching up. I don't think it's going to stop. I think it's going to hit 50 pretty quickly. If we get above 50, 95 is the next target if you do old school technical analysis, however you do it. But I just think it's a trend is up. I'm going to just continue to run a trailing stop and see where this thing ends up. So let's just bypass all that. Everybody knows the rest of that stuff. So let's answer this question, which I found was phenomenal, and like you and I are the perfect people to talk about this, especially you probably remember most of these off the top of your head. So Jason Kashab, can you share some books where one can get into history of the markets?
So the easiest way to get into the history of markets is to read all the interviews that you can, going back to different eras of the fund managers. So the Markets Wizards book, that's new, but there is an author called, I'm probably going to mangle the name, Kirk Kazanjian, Kazanjian. He does a lot of interviews with fund managers, mutual fund managers from different countries. So you have to go read all these books. So there's Inside the House of Money, there's More Money Than God. And then if you want to get into history, you have to, the absolute must read is Lords of Finance. It talks about the nexus between the Federal Reserve Bank and the Bank of England during the Great Depression, like before and during the Great Depression. So that's one. And other than that, Jim Rogers' Hot Commodities, because he goes in depth into commodity cycles on, and the book is split by metal. So and it's a very easy read. And other than that, I can't think of anything off the top of my head. But you should check out Murray Rothbard's books. So he's a Austrian economist, and it's economic history, not market history, but they are interrelated.
What was his name again? What was the name again?
Rothbard.
Oh, Rothbard. Okay. Sorry, you broke up for a sec, so just want to put that in the chat.
Yeah, and Lords of Finance by Liaquat Ahmad.
So yeah, for me, I have the same. What's funny is I was thinking about this, and I was like, Shop will probably answer similar to me, which is, I think that reading the interviews and the books from the time and seeing what's actually going on, like through their eyes at that moment, is very important. And you're going to find bad calls and you're going to find good calls and so on. But that's also like where we're at. That's how you trade. Like, I don't know the future right now. So learning from people who are also learning and seeing that time, and then being able to go back and going, okay, Market Wizards was in the 80s. Let's see what the market's doing right now, or early 90s. Let's see what the market's doing right now. Okay, the market did this after the interview. This is what happened. This is what these guys were saying. This is what they were seeing. Maybe I could see something different. Maybe I could do it in a different way, or have a different methodology that would help. Or maybe I can listen to them direct. Like somebody like Bruce Kovner, to me, was really spot on with his understanding of markets. And it was a mixture of fundamentals, technicals, understanding that, hey, there might be an idea I have, but sometimes the price is going to go against that, and I should probably follow the price. That was always very significant to me as a trader, to just learn that. What's another? I like a lot of history books, just to understand, like, if you really want to get into it, The History of Rome by Edward Gibbons. It's deep, it's long. You're going to spend probably a year reading this, but man, once you do, you really get an understanding of what happens to an empire what the markets were doing at the time, what the currency was doing at the time, what the economics of the state was. That's something that's significant. Devil in the Hindmost, that's a good one. I think you recommended that to me at one point, actually. That's a great book. If you get into the what's another great one? If you get into the Market Wizard series, I think that's one of the best ways to just kind of get an understanding, and people will do it. I'm trying to think of things Kashop didn't name. Lessons from an Economic Hitman is one of my favorites too. That's very commodity related, very politically related, but you get a good understanding of, like, when you're seeing a situation happen, like what's going on with Gaza, Israel, the Middle East, Iran, and so on. You get an understanding of what's really happening as opposed to what the news is telling you. And most importantly about all this stuff is read books that help you learn to think for yourself. This is the most important thing with everything in life. If you can find books from people who will tell you the truth about history, and that sounds funny to say, because people are like, why did he say tell the truth about history? Because there's a lot of BS out there about history. There's a lot of, you read a book and a lot of things are covered up, and I'm not saying that the authors are BS. I'm just saying that there is a lot of things that just aren't really true because they're not digging in the right way. Try to find really good writers who are going to dig into those things. But this could be a whole post. I should make a post about this. You should too, where it's, hey, let's figure out what market history books. I mean, you see behind me, I have a ton of these. So I'm sure I could find a ton, but I'm going to make a post about good books to read on the market at some point in the next week or so. So I'll do that. If you guys are my subscribers on Substack, you'll see that soon. But yeah, let's end on that, unless you have anything else to add.
I think we are good.
Okay. All right, guys. Well, thanks for joining us. We're here every Friday. Now we're at 10 a.m. I had something usually at 11. Today I didn't. But it's great to see you guys. Thanks for joining us in the chat. And we'll see you guys next week at 10 a.m.
Bye, guys.